let's talk about the mystery charts and the methodology in action. This is the TFPM, which was a gold stock from not that long ago, and I wanted to show you that there was some persistency in this chart, but there was a lot of acceleration going into the setup, and we had a Landry light pullback, which I'll give you the rules to that toward the end of the presentation. Anyway, you can see the parameters down below: entry, protective stop, IPT, that's initial profit target. And this is what it's looked like so far. It triggered, but then unfortunately it's come back in. So far it hasn't stopped out though, so we'll see what happens. Hopefully, at worst, it'll become better than poking the eye trade, but it doesn't look so hot just yet. CCL, another one of these mystery charts. You can see that it was still headed higher based on the Landry proper order down here, which is 10 simple greater than 20 exponential greater than 30 exponential moving averages. But notice that it was trading sideways, and then it went back to uptrend proper order, made all-time highs, but came right back in. And then we had the bow tie, where the proper order switches or flips from uptrend proper order to downtrend proper order, giving the appearance, obviously, of a bow tie. And then you look to get in on the first pullback. It could be as little as a 1-bar pullback after that. Entry's there, stop was there, initial profit target was here. And then when you hit the initial profit target, you bring your stop down to break even. And then as the market moves more and more in your favor, you trail that stop lower. And we got stopped out on this gap. And this is how it turned out. Better than a poke in the eye. If every trade you made did this well, you'd be pretty wealthy. But anyway, the ultimate goal is to make a lot of money on that second low, 100%, 200%, 300%, sometimes even 500%. Obviously, that doesn't happen every day. That's why you have to grind it out. $1,000 in the first low based on 100K account, or 1%, however you want to look at that. And then hopefully something much bigger on the second. In this case, it did not, but a 1.4% gain over a relatively short period of time is better than the poke in the eye. When it comes to market timing, as I preach, it's less about beating the market and more about not letting the market beat you. And as I've said quite a bit, the diaper changes when the market has these really crazy sell-offs, and I'm borrowing that term from Ian McActivey. And we've had a little spell recently. It's kind of pales in comparison to historical drop-offs, but it's been a pretty significant drop nonetheless. Down below, this is a percent away from the 50-week closing high, which the system is based on. You can see 50% drawdowns are really not that uncommon, and that's the scary part when it comes to markets. And nobody wants to believe that, but I've seen several in my lifetime, and I'm old, but I'm not that old. So it does happen. There's the rules. I'm not going to bore you with the rules since we talk about it every week. But that was a last sell right there. Unfortunately, if you're trading a system, however you want to look at it, the market has come right back, so far at least, which would be a good thing. In fact, we now have 1 bar of Landry light, the low is greater than that 50-week moving average, and we need 2 for a signal. So next Friday, we could actually have a buy signal with this. So this is a V-shaped recovery, and I ran out of time. But one of my clients was talking to me about overhead resistance. He thinks I spend too much time thinking about it or worrying about it or possibly missing opportunities because of it. And I defended my position on that simply because it's just human nature. And I'm going to show you some of that human nature in just 1 second. And then next week, I'll flesh out more of my answer, which I published to, I think I published to Twitter and to Substack. But anyway, so nice big V-shaped recovery so far. So market timing doesn't really work when you have a V-shaped recovery. The ultimate goal of market timing is to avoid the diaper change moment. So it doesn't really work well with the V-shaped recovery. Spoiler alert, or does it? Anyway, so if you take a look at the pandemic sell signal back in 2020, so in February 27, the market began to take the pandemic fairly seriously, and then it began to tumble afterwards. Now, if we take a look at that sell signal, you were out right there. That's February 27th. And then you got a buy signal in July, okay? So you're actually getting back in higher than you got out. So technically, that would be known as a whipsaw. So let's take a look at that in a little bit more detail. We zoom that in. You got out at 30.46, and then you got back in at 32.25. So that's 179 points you gave up by not just staying in. If you just stayed in, you would be 6% ahead, right? So this was an opportunity cost, so to speak, or a whipsaw, and a whipsaw. But you avoided nearly a 30% diaper change moment. And the story I've told many times. A friend of mine was passing through town. They have a place not too far from here now, about an hour away or so. But before they had the place, they would kind of use our house as home base to visit his son who lives in our town. And he was kind of white as a ghost when this market kept dropping, looking at the ticker on the screen. And he wasn't sleeping at night. He's retired now, but he was nearing retirement. He was only a few years out from retirement at the time, and he was not doing well at this time. So yeah, there was an opportunity cost, a fairly significant opportunity cost miss, right? But you're also able to sleep at night, and there's no guarantee that 28% couldn't have turned into a 50% loss. And a lot of times when I'm talking about market timing, I go way back to the 20s and all, and the 70s, which were abysmal too. But even in more recent times, the market has lost more than half of its value. And go back to 2000, the NASDAQ lost 72% of its value, to show you how serious this could be. And the recovery times, I think the 2008 recovery, or one of those recoveries, we could back up to the charts, but one of those recoveries took, I think, 13 years. And, my friends my age, a little older, 13 years when you're pretty damn close to retirement is a long time to wait for your money to come back. You might need your money in the meantime. So I still think the system, I'm defending my system, which is a free system, but I'm defending it it did its job, okay? It got you out of the way. Now, did it get you back in? It got you back in a little bit late, but that's what trend following is all about. And I think that's one of the things that my client was pointing out was like, we missed opportunities because I'm being too cautious. Well, by the way, just a side note, I do put out a Landry list every day, and the official recommendations come from that Landry list, but there were some big winners in that Landry list during this recent run, but I felt they were too risky to recommend, but I do put them out there for others. And I did take, and I'm not throwing salt in anybody's wounds, I did take some of those setups, and they weren't working fantastically, but today looks like they're nicely in the black. TOI and YALA would be two from the Landry list. Now, let me turn things on its head. So I said that systems don't work, or market timing doesn't work, when the market makes a big V-shaped recovery. You get out, market spikes down, and then spikes right back up. Well, as I just said, you do avoid that spike down, which allows you to sleep at night. You just get back in a little bit later, which, again, opportunity cost. So I've been thinking lately, maybe the reason market timing works is because sometimes it doesn't during those V-shaped recoveries. Now, I'm a man on the street kind of guy, and this kind of dovetails in with the overhead supply comment that was I was talking with a client about. And I think that you have to pay attention to overhead supply, and you want to stack the odds in your favor. Now, overhead supply is just a spot where people have likely bought and will likely get out when they get back to break even. And if that doesn't happen, that's when you end up having that longer term bear market, because people like my aforementioned friend eventually get forced out because he's thinking like, okay, my $1 million went to or $2 million went to $1 million, and that's beginning to erode away. And geez, I don't want to. I want to enjoy myself in retirement. I don't want to just scrape by. But again, being a man on the street in the gym, it's like a lot of the guys in there, older guys especially. I work out in the mornings, and I think Silver Sneakers, which is a healthcare plan for older people, a lot of those guys get free workouts as long as they work out. That the gym reports back to the company whether or not they worked out or not. And so there's a lot of old guys in there, present company included, I suppose. But they're saying things like, it'll come back. It always comes back. Well, it always comes back but it might take 13 years, like I just said, or it might take 25 years. And I've seen somebody make the argument, if you're a young person, the market has never had a bad 30-year period. It's like, well, okay, who's to say it might not stretch out a little bit more than 30 years? And what if you did maybe do a little market timing? Now, if you have forever in your time horizon, you're 20 years old, maybe you need to be, I hate to say this, but maybe you could be a little bit more lax in your market timing and not worry about it so much. But I think you would do even better if you applied market timing. So think about this. If you avoid the occasional 50% drop, then you're going to have a lot more money longer term in the markets. But a lot of people, it always comes back. Well, it doesn't always come back. I mean, yeah, 25 years, it'll come back, maybe 30. And then, of course, the market always goes up longer term. One thing interesting here is after I published the Layman's Guide to Trading Stocks, where I think I talked about market myths in there, and this was one of them, the market always comes back. Afterwards, Greg Morris, in a presentation, pointed out that there's a lot of it's just common knowledge or whatever, that the market always goes up longer term, and it's like some pretty decent number, like 12% a year. Well, those numbers are based on like an 80-time year horizon. And like Greg pointed out, it's like, well, you're in your young 20s, you're trying to get by, you're trying to climb the corporate ladder, you're really busy, you might get married, you might have some kids, and then you're trying to get a house, and nowadays that seems harder and harder and harder. So you don't have a lot of money to put aside and put it to the market. So you might be a little older before you actually start being able to invest in the markets. So 80 years, as Sweet Brown, quoting Sweet Brown, I should say, is ain't nobody got time for that. Anyway, we sell signal here. This was back in 2008. By the way, in 2007, again, always look at the charts. It's like the market was kind of bumping along, making new highs in 2007, and right around October or so, I couldn't find a long to save my life, and I apologize to my clients for showing so many shorts, but that's all the market was providing. And you could actually go back and look at those setups. Like, well, what does Big Dave do in a bear market? Go back and look at 2008. I'm not sure how far the archives go back. I know there's a gap in them somewhere, but I think I have 2008 out there. Anyway, you can see pretty serious slide, 52% slide in the market. And I think that's after the signal. But even if it's not, you can see it's still a significant slide you would have avoided with market timing. So market timing works in kind of a perverse sense, because sometimes it doesn't. It lulls people into bad behavior. And the other thing too, what you have to realize, and this is kind of a crazy thing with markets, is so far we're plowing through that overhead supply, and we might just plow through it. I hope we do, but I think you have to respect it. And even if we do plow through it, and as my client was pointing out, this has happened more than once throughout history, you're probably not getting a representative sample because you don't have enough occurrences of that. And so I still think trading in a conceptually correct manner, because human nature never changes, is important. Yeah, you might tweak things a little bit here and there, but for the most part, you should pay attention to those things. But anyway, I just want to get that out real quick. I'm not going to spend a lot of time on the Landry 100, but speculation is alive and well. And the jury's still out on how this is going to do this time. I did this years ago, as I've said 1,000 times. And the software I was using to track it was no longer available, and some other things happened, and the market just chopped around forever, and I got bored with it. But I'm going to try to stick to it this time. And there's no money management built into this. This is hypothetical, okay? Although I have taken some of the trades out of the Landry 100 personally, in a small way, kind of an experimental basis. But anyway, the premise is you just buy a stock, and ideally you want a higher HV type stock, higher historical volatility stock, as it's making closing at 52-week closing highs. Now, if we were to get into an extended bear market, then maybe I drop that down to maybe as low as a 3-month high, a 90-day high. But for now, I'm still using the 52-week high for that. So all these were bought at 52-week highs. So this was a buy here, and this thing ran 614%, and then it's had a pretty serious drop since. But I left it in because it's still, for the most part, headed higher, although it's a pretty serious drawdown. And that's what comes with longer term trend following. And that's another one of those proof of concept things. But I would highly recommend you take profits. And one of the things that I've kind of noodled with a little bit is maybe I should take profits at 100%, because this one here, that's 100%. And let's see what that TOI was. I just mentioned that one. TOI was 137%. And I probably need to be, again, taking partial profits on those. Now, the TOI in my experiment, it wasn't a whole lot. It was just kind of like an experimental basis. When it did get to 100%, I did take off half of those shares. Here's some random thoughts from several weeks ago, and I've been repeating them weekly. Momentum ends badly, as you know. Eventually, you're going to have the mother of all drawdowns, and then what appears to initially be a correction turns out to be something else. Real estate to the bear market is okay. We had some grocery stores in there. I took them out yesterday, and some of them made a couple percent. Some of them lost a couple percent. Overall, it really wasn't worth it. Some other areas did okay for a little while, but then the sell-off caught up to them. So that's the dangerous thing about trading relative strength in a bear market. Unless you have a setup that just looks absolutely fantastic, something a little bit more speculative like the TOI or something like that, then you're better off sitting on your hands. But it is a great way to see where the money's flowing. Just like recently, it's like, oh, it looks like the money's flowing to grocery stores. Well, that's obviously a defensive type of area. Money was kind of flowing into drugs for a while, then drugs kind of roll back over, obviously. So it's kind of a cool thing. And I know I'm a nerd, and you probably want to party with me, but it's fun to watch the sector rotation and the ebbs and flows. Goals, for instance, we just had when I say we, I'd be me, myself, and I. We had a lot of goals in there, gold stock, GOLD, but those are coming out. A lot of those came out just yesterday. Cash is not trash. Also, I've done complete presentations just on that. And a lot of times people will say cash is trash. Well, sometimes return of capital is more important than return on capital.